Commodities. Let's just take a look at where we closed for the week, starting out in the corn market. March corn futures closed 9 cents higher, just a hair over 9 cents at 374.5 this week. Soybeans up 32 cents this week in the March contract at 10.59. March wheat up just shy of 19 cents at 4.49. And taking a look at cattle, Feb cattle down 50 cents on the week at 116.40. February hogs up $4.23 on the week, the big winner at 74.55. Looks as if the dollar is going to close stronger in the week, still trading at this point at 100.8 points here. It looks like oil is fairly steady on the week. It's going to close shy of $54 on the nearby contract. The main item this week for the grains was the monthly supply and demand report. Usually a little bit of a whole hummer in February. We know what the supply is. It's not changed. The question is, what are we going to do with the demand side of the equation? And we did increase ethanol grind in the corn side of the equation. So we were we're down in our carryout down to 2.32 billion bushels, and that came pretty much in line with what the average trade guess was going to be. The last one was 2.355 billion bushels, so really a non-event as far as the trade would be concerned, as far as the numbers are concerned, very little change there. Soybeans, the trade was looking actually for a smaller carryout, and the USDA punted on this one, left everything unchanged. 420 million was our carryout. It's been the carryout for January and a carryout for February. The trade was looking for a cut down to 405, some whisper numbers below 400 million. Trade was looking for an increase in export demand, and that's been the case for both corn and beans. We did see the demand push on the export, or on the ethanol again. We didn't see it for corn or beans. They are ahead of the 5-year average as far as a percentage of what the demand number would be. But the concern moving forward is, are we going to see our exports replaced by South America as time moves on? And therein lies a concern as well. When you take a look at the world numbers, we did see a cut in both corn and beans and wheat as well in the supply and demand report from a world perspective. We'd left Brazil's yield alone as far as soybeans was concerned. We actually cut Argentina's. The trade was looking for a cut there. But when we take a look at the growing season right now, the trade views Brazil's growing season, or their soy production right now, probably as growing, and we're probably viewing Argentina's production as at least stabilizing, not getting worse at this point. We are in more or less their pod fill season in beans right now, and it's more of an extended season than ours. But as we move through the month of February into March, we're going to run out of weather concerns, at least for soybeans. We are planting the safrinha corn crop right now. That's their bigger crop, their second crop. In Brazil, we are ahead of the 5-year average as far as a percentage is concerned of getting that in. We're actually ahead of the 5-year of harvesting as well in Brazil. But it's some confusing reports out there. I think some of the trade think we're behind because it was planted early. It should be harvested a little bit faster, but they are fighting the rains. We are ahead of progress. We'll see what the next few weeks unfold as far as getting then a good chunk of that harvest in the books. So again, as we move forward, the million-dollar question is how big a crop are they going to have, and when will it start replacing our exports? Now, at this point, the Brazilian farmer is undersold compared to years past, and he's a seller of beans more due to a currency exchange more so than anything else. And right now, their currency, the real, is pretty strong compared to the dollar, and they like to see a stronger dollar, weaker real, which stimulates some of their sales. and we're not seeing that here at the moment. At some point, the South American farmer, Brazil farmer, will have to come to the plate and start selling this thing, and then we would put that natural seller back into the marketplace. Right now, we're not seeing anything being sold as far as the natural seller and soybeans. We are seeing some money move into the commodities as a whole. Commitment of Traders report this week, which is a view of a snapshot of what the managed money is doing. It's a report that comes through Tuesday of this week. We showed that we've seen a lot of length come back into corn, around 25,000 contracts. That puts them long, around 29,000 contracts. Beans was fairly neutral this week. Through Tuesday, the managed money is still holding somewhere around 150,000 contracts of beans. It's a little less than maybe what the estimates were looking at that report today. Talking about Commitment of Traders report, just to take a look at cattle and hogs. The managed money is still holding a pretty large position in both cattle, about 103,000 contracts. They liquidated about 6,500 contracts this week, and they added about 500 contracts, still holding around 60,000 contracts of hogs. And that's a big chunk of open interest in cattle and hogs as compared to corn and beans. Speaking of the livestock futures, we've seen a cash cattle trade a wide range this week, viewed a little bit disappointing. Stronger in the south, 120s in the south. On the low end in the northern corn belt, up in 115. 115 and a half, the low end of that trade. The farther north you go, cutouts fairly steady for the most part this week. The packer is viewed to be trying to make some margin in here. His margins has been squeezed as far as beef is concerned. December exports for beef were down a little bit from February, still pretty good, down a little bit from February. Taking a look at hogs, hog pork exports have been very, very good. Great month in November. Wasn't expected to be nearly as good for December. It wasn't, but it still was very good. Probably better than expected. We're seeing that obviously played out in the cash market as it continues to grind higher. The cutout continues to grind higher. At this point, February looks to expire, or is going to expire next Tuesday, the last trade. Usually you see that cash contract, cash and that contract come into play as far as merging there. So we're seeing strong cash continue to hold the Fed. But we did see the deferred month sell off a little bit this week. April will become the lead month then by the middle of next week. And the concern moving forward is we're still looking at much larger production estimates coming down the pike, and the trade has still been surprised by the strong front-end demand of this market. So cash at this point is going to need to continue to firm and hold these deferred prices, but we've had a chance to sell some June and July hogs over $80 for about a day. And that's all we've had to this point. If we get that opportunity, I think it's probably an excellent opportunity to get some protection and or some hedges in place. So if you have any questions about these or any of the markets, please feel free to give us a call here at BIS Commodities at 1-800-373-2525.